You enter a long position on gold. The price climbs steadily. You're up 50 pips, the setup looks flawless, and the profit margin is widening. Then, without warning, the order book empties out. A massive red candle swallows 3 days of gains in 45 seconds, blowing right past your stop loss. Your account is liquidated. Intermediate traders fall into this specific trap over and over. They map out the gold to US dollar pair, XAUUSD, exactly as they would a standard currency pair, like the euro-dollar, expecting it to follow the exact same technical rules. But gold is a physical commodity. It acts as a global safe haven and an inflation hedge. Instead of reacting to the localized economic data of two competing nations, it responds to massive worldwide shifts in fear and greed. Applying a standard Forex strategy to this asset ignores its unique macro drivers. If you don't account for what actually moves institutional capital in the gold market, you are trading on borrowed time. Let's wind the clock back to the start of that failed trade. The very first error happened before the position was even opened, analyzing the gold chart entirely in isolation. This split-screen visualization demonstrates a mechanical rule of pricing. Because gold is valued in US dollars, the two maintain an inverse relationship. When the US dollar index, or DXY, strengthens on the left, it takes fewer dollars to buy an ounce of gold, forcing the XAUUSD price down on the right. The same dynamic applies to US bond yields. When the 10-year Treasury yield rises, it competes directly with gold for investor capital, pushing the price down even further. The heavy institutional money moves in response to these exact forces. When inflation data rises, fiat currency weakens, and capital floods into gold. The primary catalyst for these shifts is the US Federal Reserve. Because gold pays no interest, any rate hikes from the Fed make non-yielding assets less attractive, triggering immediate sell-offs. Locking onto a 15-minute chart while ignoring interest rates and the DXY leaves you completely exposed to the macroeconomic currents driving the price. Now advance to the exact minute the position collapsed. The catalyst wasn't a technical failure, it was a scheduled high-impact economic release. Reports like the non-farm payrolls or the consumer price index act as massive volatility triggers for the global financial system. This animated candlestick pattern illustrates what we call a whipsaw. During a major news drop, institutional algorithms flood the market, driving the price $20 up to hunt retail buy stops, then immediately plunging $30 to clear out the sell stops, all before picking a true direction. If you hold a position during this window, normal market mechanics break down. Liquidity disappears, spreads widen severely, and execution delays mean your order will slip far past your intended exit price. Attempting to trade through this chaos is a coin flip. The most effective strategy for surviving high-impact data is closing your positions 30 minutes prior and staying completely flat. Let's look at the trader's final line of defense. They used a strict 10-pip stop loss. Given gold's massive daily range, placing a tight, arbitrary number like that practically guarantees you'll be knocked out by normal, everyday price fluctuations. This dark mode chart illustrates the proper institutional approach. First, you place your stop loss below a structural swing low. Then, you buffer it using the average true range, a tool that measures the average price movement over a set period. Setting the stop 1.5 times the ATR below your entry keeps you safe from standard market noise. But widening your stop means increasing your risk. To fix this, you must use a position sizing calculator, reducing your lot size so that even with a wider ATR buffer, a loss never exceeds exactly 1% of your account capital. When a trade fails anyway, the immediate psychological response is anger. Traders jump back in with a massive lot size on a low-quality setup, desperately trying to win the money back. To break this cycle of revenge trading, you need hard constraints, a mandatory 15-minute physical break from the terminal after any loss, and a strict daily drawdown limit. Hit the limit, and you shut the software down until tomorrow. A perfect technical strategy is useless if an emotional reaction causes you to abandon your risk parameters the moment you take a hit. Let's zoom in on why the trader entered the market in the first place. They saw a single momentum indicator, like the relative strength index, cross above a line, and they bought. This line chart demonstrates the fatal flaw of that approach. In a powerful gold trend, an indicator like the RSI can become trapped in the overbought zone for weeks. If you sell just because a single line crossed 70, you will take hit after hit against the dominant trend. The alternative is confluence. This means demanding multiple unrelated signals, like a macro trend confirmation, a structural breakout, and a volume indicator across different timeframes, all aligning before you risk a dollar. Looking for a magic single indicator bullet guarantees false signals. Stacking non-correlated data points acts as a ruthless filter, ensuring you only enter high-probability setups. Let's run the exact same setup through the confluence framework. We check the DXY. We verify no incoming inflation data. We align multiple timeframes, and we adjust our lot size to a strict 1% risk. The market dips, but the ATR buffered stop holds. The institutional capital flows back in, and the position secures a calculated, structured profit. Consistently profiting from XAUUSD does not require predicting the future. It requires neutralizing your emotions and using strict risk management to minimize the damage when you're wrong. Join thousands of professional traders on FXNX. Open a zero-risk demo account today to practice these advanced principles and test your edge in the market.